Hello, folks. Welcome. This is Engineer of Trades 2025 Trading Lecture Series. And you can't imagine, we are in Lecture 4. How good is that? Trading variables. So we'll be looking at things like time, sessions, volatility, price, liquidity, and volume. Very well. Now, just as it is in our norm, we begin with a quote, a preamble quote. And this one is being inspired by Mark Douglas. Success in trading is not about predicting the future, but mastering the present moment. And that gets us into the objective of this lecture 4, which is to help you discover how these variables that we've just mentioned, time sessions, volatility, price, liquidity, and volume, are able to shape your trading experience and improve your trading performance in the long haul. Okay, so we'll be looking at three main things: helping you understand each variable's role, explore their interconnections, how they are interrelated and how they are connected, and most importantly, by the end of the lecture, you'll have learned how to leverage them for better trading. So let us begin the first one. So we begin by understanding what exactly are these trading variables that we're talking about. And basically, they're just six elements that do define, market dynamics. Okay, they are like things that summarize it all. They summarize what the market is all about. The movements in the market, your trading experience, they shape it, and most importantly, they do influence your trading outcomes. And we've just mentioned them, so I'm just going to quickly mention them again. Trading time, we have trading sessions, we've got volatility, we've got price, we've got liquidity, and then we've got volume. And just as I've been mentioning again and again, these variables help you interact and to create opportunities and risk, in the market. So we move on to the first one, which is trading time. And basically, this is the special moments or the specific times that you're able to enter and exit a trade. Or think of them as very specific times when trading happens. Okay. So there is one thing that will be repeated again and again. Just because you are a full-time trader, or just because you you call yourself a full-time trader, doesn't mean that you should be trading at all times. There are very specific times when the market behaves in a very specific time. I mean, in a very specific way. And it is now your obligation to understand these specific times, these specific moments, and using them, you are able to define your entries and your exits in the markets. Okay. And with that, of course, you're able to arrange your personal schedule and incorporating the market hours as well. Very well. So the next one is trading sessions. We have three distinct trading sessions. We have one in the Asian, it's called Asian session. We have European session and we have US session. Okay. So these three main sessions, most of the assets that you trade, they either fall in the category, one of these categories. Okay, so if you are into forex and you focus with a pair like euro USD, okay, or a pair like euro JPY, you see we have a yen pair there. And so, as long as there is a yen and the yen is in Japan, which happens to be under the Asian session, you expect to have very good intraday movements or very good price fluctuations during Asian session. It's that simple. If maybe you are trading stocks, okay, perhaps you're trading a stock like Tesla. So Tesla is listed in the US markets. So you do not expect to have a good price movements during Asian session or during European session. Let's say again you're trading a stock index like DAX or German 40 or US 1, I mean UK 100. They are listed in the European markets. So you do not expect to have good movements or exactly during Asian session, or most importantly, maybe during your session per se, but we are going to have some sort of uh, an add-on on that. But most importantly, you expect to have good price movements during European session as long as you are trading a stock index with an inclination which is listed in the European markets. It's that simple, okay? And so the characteristics of these sessions, the Asian session, it has a lower volatility, and during that session, it will do you good to focus on only yen pairs, okay? Any pair that ends with a yen, okay? Euro JPY, GBP JPY, USD JPY, okay? Very well. So then we move on to the European session. That one has a high activity. But again, if you are into Forex, it will do you good to focus on instruments which have which have a euro in them, or which have a pound in them. Okay, so Euro USD, GBP JPY, okay, such kind of things. Then, most importantly, we have the US session. The most traded session. Actually, European session and the US session, they share kind of, almost the same activity, but the US session has more trading activity, unlike the European session. Okay, so the US session is a more broad market impact. So, but most importantly, any asset that has a connection to USD, the dollar, will have very good movements. Okay, so let us look at the interrelation of these or of this trading session with the other things, with the other trading variables. So time, the interrelation between time and the trading sessions. The sessions dictate the optimal trading windows. Okay, so the trading time that you're going to choose to trade that specific asset will be influenced mostly by the trading session you operate within. Volatility. Okay, we are going to, we already seeing, if you look at the chart below there, okay, we begin with the first column, which is London, okay? And this is New York time, UTC -5, New York time. And you see, London begins at 3 a.m. New York time and ends at 11 a.m. New York time, okay? But again, you see there is an overlap just after 4 hours into trading, and that overlap is sustained for the next 3 hours. So that tells you that time window where there is an overlap between the London session and the New York session, there happens to be a lot of trading activity. There happens to be a lot of good price fluctuations. Okay. And that tells you we are going to have a lot of volatility. We are just about to look at what volatility really is. Okay. But you, as a trader, you want to position yourself and you want to capture those, you want to plan your trading time during those times when the session is beginning, or rather when there is an overlap between one trading session and the other trading session. And this is a very good example of that. Then we have another session that has a very good overlap. That is if you operate within the Asian sessions. Okay, if you do have assets that have a connection with the yen. So the Sydney and the Tokyo markets, they have, as soon as the Sydney market opens 2 hours into trading, there is an overlap between the Sydney markets and the Tokyo markets. So that again, understanding that from the onset, it's very good for your trading. Very well. Then lastly, there we have the interrelation between volume and the trading session. So higher in major sessions, the we have high volume during major sessions like London and during major sessions like New York session. Okay. But most importantly, when we have that overlap between London session and the New York session, we expect to see high volumes being injected into the markets. Trading during active sessions enhances your executions and opportunities. So we move on to the next one. Volatility. So, what exactly is volatility? It is just basically what I've been mentioning. It is the degree of price fluctuations over time, just the manner in which price fluctuates. So, let's say you are trading an instrument like pound USD and it is priced at 1.25697. Okay. And then after like 20 minutes or 30 minutes, we have an increase with 300 pips or 200 pips or 100 pips just within a very small period of time. That tells you there is good volatility. Or let's take another example. You're trading an instrument like US 100 or NASDAQ 100. And just when you have executed your position, the price of US 100 was at 2695. And then just after like 20, 10 minutes or 30 minutes into trading, that price fluctuates, goes down with 200 points. So that is going to be 2495. That is a huge price fluctuation. And that tells you there is a high volatility in the market. So using this chart that you're seeing there are those two lines within there. I mean, in that chart, we have the different session. We have the Asian session beginning there, then we have European session, then we have the American or the US session. But you can also see two lines. We have the white one, which represents asset return. But I want us to focus most importantly on the second line, which has an orange color, the volatility one. And you see clearly during Asian session, the volatility is low using that curve. But as we approach the European session and as European session begins to gain momentum, volatility begins to peak. And as we approach the American session, the US session, and as we are having that overlap between European session and the Americans and the US session, we have the peak of volatility. And that one is sustained for the next few hours into US session until we have the afternoon session of the US session when volatility begins to decline. So understanding volatility and the times you expect to have a lot of volatility is really key into planning your trading. Then we also have influences of news when we're having major news being released into the market. Maybe news about inflation, maybe news about which are affecting the strength of the dollar. You see, when all these things are being released, they tend to spike up the volatility into the markets. Just a parting note on this one: high volatility offers profit potential but requires strict risk management. Actually, I prefer to say volatility is a double-edged sword. Okay, it gives you good opportunities in the market, wonderful opportunities in the market, but also on the other side, it can also be very detrimental to your trading capital. You can also accumulate huge losses during those times with volatility. So that is why good risk management has to be brought on board. Do not worry about this risk management you're talking about. That will be handled in the coming lectures. Let us move forward. We look at close to the last trading variable price. This is not something new. Everything allowed trading revolves allowed price. So what is price? It is basically the current value of an asset. It is, and again, it is reflected by the amount of supply and demand in the market, and also the market sentiment, the perception from traders, or rather the different participants in the market. So just understand that price is basically the current value of an asset. And then we have things that influence price. We have order flow. We looked at order flow in the past lectures. We have news. I've just mentioned that in the past slide. And then we also have participant actions. This is basically the perception that traders have about a particular asset, and that affects the price of that asset in the long haul. Now, again, we look at the interrelation between the other variables and price. So we expect to see huge price swings when there is high volatility. That's simple. Then we also expect to see things like price gaps, or rather instances of imbalances in markets when there is low liquidity. Again, we looked at what liquidity is in the past lectures, but we're also going to have a quick look into it in the coming slides. Then the interconnected between price and volume. You see, when we have high volume in the markets, you expect to see good price trades. Okay, so you having a good grasp of price analysis, it ensures that you have very good entries and very good exits in the market. And this is what this trading lecture series is all about helping you be in a position to have very good price analysis, very you have a good grasp of reading price action. So we move on to the next one, liquidity. I will not spend a lot of time here. We have looked at what liquidity is, and it is basically just the ability to buy or sell an asset without really um, affecting its price. So, of course, high liquidity goes hand in hand with tight spreads, or rather, little or minimal expenses, and there is fast execution. Low liquidity goes hand in hand with wide spreads, and we have issues with slippage. And slippage, what exactly it is you are executing your position. Let's say for an instrument like DAX German 40, and German 40 is trading at 19,805, but due to low liquidity, we and you having this problem with slippage, instead of you being filled at 28, I mean 19,805, you'll be filled at 19,820. So you already have a deviation of 15 points from the price you wanted to be filled in, and I mean at, and the price that you've been filled at. But for you to avoid that, you gotta have to trade during those times when there is high liquidity. Very well. We move on to the next slide. We look at volume. So we begin by understanding what exactly volume is. And volume is just the amount of orders of a particular asset being traded over a period of time. Okay. You can put it in simple terms, the number of assets traded over a period. So let's say for an instrument like we have a good one, a forex pair like New Zealand dollar versus the dollar. Okay, NZD USD. Okay, so you are seeing in the order book, or you are seeing a volume, you're seeing a huge spike, okay, in the volume of NZD USD. But what this volume really is, it is the number of lots being traded for that specific time or over a period of time. So the more orders, I mean, the more orders and the more lots we have, translating into the amount of volume in the market, the more activity there is in the market and the more good movement there are. So the role of volume in the market is to help you confirm trades, and it indicates that there is good momentum and there is good opportunities in the market. I mean, there are higher chances of having good opportunities in the market. So a good example, if you have a high volume on a stock like Tesla, okay, and then we see a breakout. A breakout is really just that huge spike from a price where a price was consolidating. Don't worry, we're going to look at these things in more with a lot of visuals in the coming lectures. So if you have that high volume on a stock like Tesla, after a breakout has happened, that huge, that sharp spike, that validates the movement. So again, if you look at that chart there, and where I have put that arrow, increased volume on the down there. So if you are using a platform like TradingView or MT5, there is within the settings where you set to see, bars on the horizontal axis, and they are always showing you the volume in the market. So when you begin seeing very high bars, that tells you we already have a spike in volume. And when we have that spike in volume, it goes hand in hand with very good movements that accompany that volume. So let's look at the interrelation. So liquidity and volume. We have high volume enhances good liquidity. Price. We have huge volumes, and that drives price trades. Then session, of course, volume. We have huge volumes during major session, and of course during uh, session overlaps. So we conclude by looking at, why do these variables matter? Okay, why do these variables matter? Why do liquidity matter? Why do volume matter? Why do volatility matter? Everything that we have looked at in this lecture. And it is that is summarized in these four things. One, and having a good grasp of these variables, it puts you in a position where you're able to have good entries and good exits in the markets. Okay, so you are not chasing really, those faulty entries or those faulty exits. Secondly, having a good grasp of these variables, you're able to manage your risk well in the market. You see, this is a game of risk management in the long run. So when we have high volatility, then you should work with very good stops and you should have very tight stops. The third reason, understanding these variables, things like volume, they are able to put you in a position where you have trade confirmation. So, and you're able to take advantage and ride those trades. Lastly, when you have a good grasp of these variables, you're in a position where you have good execution and you have efficiency in your executions, something of that sort. And we conclude by looking at this example, which has been put there. If, for instance, you are working with an asset like pound dollar during London session when there is high volume and good liquidity, that will typically help you minimize your costs, your trading expenses. That means you not be having huge spreads, you not be having issues with your slippage. And most importantly, trading GBP USD at such a time helps you, maximizes your opportunity or your chances of capturing a trade should it rise or should it present itself at that specific time. So that is all we had in this lecture series. As always, I am really glad that you followed through up to this point, and thank you very much. That was the end of lecture 4. I'll see you in the lecture 5.